Welcome to Tech Money Madness, your daily U.S. stock market deep dive. Today is Wednesday, June 10th, 2026. And we have a wildly chaotic stack of market updates to get through today.
Yeah, chaotic is definitely the right word for it. It's a really strange day in the markets.
Right. I mean, on one side of the planet, you've got the smartest investors in the world throwing like $75 billion at a literal science fiction dream to colonize space.
It is just a staggering amount of capital.
Completely staggering. And then on the exact same day, we are reading reports about a flesh-eating parasite that is threatening to crash the global food supply chain.
It really perfectly illustrates how the global economy is operating in two completely different realities right now.
Exactly. And so our mission today for this deep dive is to take this massive daily briefing and extract the actual mechanics of what is driving your portfolio today.
Because you have the physical world, which is grinding to a halt under these severe old-school constraints.
Right.
And then you have the digital world, which is launching the most expensive bets in human history.
And before we get into the mechanics of those bets, I just want to give a quick format note for you listening. Today's briefing covers some pretty heavy political and geopolitical development.
Very heavy.
And we are unpacking these documents completely impartially. We aren't taking sides here. We are simply looking at these events strictly as data points, just to give you the clearest possible view of how capital is actually moving.
Because the market itself doesn't have a political affiliation. It really doesn't.
No, it just cares about the math.
Exactly. It operates purely on risk, supply, demand, and capital allocation. And today, those four elements are engaged in an incredibly volatile tug of war.
So let's start by looking at the gritty reality of the physical world, because before we can even talk about these trillion-dollar tech valuations, we have to look at the macroeconomic anchor that's just holding everything down right now.
The physical constraints.
Right. According to this briefing, the Consumer Price Index, the CPI, has officially hit a 3-year high.
And that 3-year mark, that is really critical to understand, because the CPI measures the average change in prices that consumers pay for a basket of goods and services.
It's basically the baseline cost of living.
Exactly. The baseline cost of living and the fundamental cost of doing business. When inflation stays elevated for 3 continuous years, it isn't just sticky anymore. It is compounding.
Meaning the baseline has permanently shifted.
Precisely. If inflation is at, say, 4% one year and then 4% the next year, you aren't just paying 4% more than when you started.
You're paying 4% on top of the already inflated prices from the year before.
Right, it compounds. So every single physical action a company takes, whether that's shipping a cardboard box, buying raw materials, or just, running the electricity in a warehouse, it is exponentially more expensive today than it was 3 years ago.
It just drains corporate cash reserves.
At an alarming rate, yeah.
And this inflation number is currently colliding head-on with geopolitics today. The briefing notes that President Trump stated a deal with Iran is close, despite the ongoing conflict.
Right. That was a major headline this morning.
And his suggestion is that once the U.S. war against Iran ends, we are going to see inflation finally drop. But I am looking at the commodity charts from today, and despite that talk of a deal from the White House, oil prices actually rose.
Yeah, and this is a perfect example of the disconnect between political timelines and market mechanics.
How so?
Well, politicians trade in futures, essentially. They trade in promises of what will happen eventually, right?
Yeah, the we're close to a deal narrative.
Exactly. But commodity traders trade in the physical reality of what a barrel of oil is doing right this exact second. And right now, the market is looking directly at the Strait of Hormuz.
Which is one of the most critical global choke points for oil supplies.
Right. Nearly a fifth of the world's oil consumption passes through that narrow stretch of water.
Wow, a fifth.
Yeah, it's massive.
Yeah.
So when there is ongoing conflict in that region, the market price is in what we call a risk premium. It is essentially the soaring cost of insurance.
Oh, because the ships are actually in danger.
Exactly. If an oil tanker company thinks there's even a fractional chance their ship could be targeted, their maritime insurance rates just skyrocket.
So it doesn't matter if a peace deal is theoretically close.
Not at all.
If the insurance to move the physical ship today is astronomical, that cost gets passed directly onto the barrel of oil.
You nailed it. And because oil powers the global supply chain, every truck, every cargo plane, every factory, that price increase immediately feeds right back into that compounding 3-year high CPI number we just talked about.
It is a brutal feedback loop.
It really is.
And speaking of the physical world actively fighting back against the economy, there are two honestly bizarre macro points in today's briefing that illustrate this friction perfectly.
Yeah, the agriculture news.
Right. First, the U.S. Agriculture Secretary is currently out there downplaying the spreading screwworm threat.
Which is just awful to even read about.
It's terrible. For those who haven't had the displeasure of reading up on this, screwworms are parasites that feed on the living tissue of warm-blooded animals. It is a biological nightmare for livestock.
And while it sounds like a hyper-local agricultural issue, you have to look at the cascading mechanism here.
How does a bug crash the market?
Well, if screwworms threaten massive herds of cattle, you aren't just looking at the price of beef going up at the grocery store, you are looking at the entire agricultural commodities market reacting.
Because everything is connected.
Right. If livestock herds have to be culled, the demand for livestock feed primarily corn and soybeans suddenly plummets.
Oh, wow.
So that crashes the corn and soybean markets, while at the exact same time, protein prices soar because there's less beef.
It completely destabilizes the entire food supply chain.
Precisely. It introduces massive volatility.
And to add insult to injury here, the briefing also notes that a highly anticipated World Cup travel boom has completely failed to materialize for U.S. businesses.
Yeah, that was a big shock for the hospitality sector.
Because all those expected tourist dollars, the hotel bookings, the restaurant surges that local economies were really relying on to offset these high inflation costs they're just missing, the tourists didn't show up.
They stayed home.
So you look at this macro state, and to me, it's like trying to plan a lavish, futuristic vacation while your house's roof is actively leaking.
That is a great way to frame it. The leaking roof is the physical economy.
Right.
The Strait of Hormuz, the screwworms, the missing tourists. None of these are isolated incidents. They collectively paint a picture of severe, unavoidable friction.
The physical world is pushing back.
Exactly, making the fundamental cost of operating more expensive across the board.
And that friction in the physical world where shipping, raw materials, and energy are just skyrocketing, that is exactly why companies are desperately trying to escape into the digital autonomy.
They want out.
Right. They want to automate, digitize, and use artificial intelligence to cut those physical costs. But as today's briefing shows, that digital escape route is suddenly hitting a massive financial wall.
A very expensive wall.
Let's look at Apple.
This was definitely the defining story of the tech sector today.
Apple had their highly anticipated AI reveal. And the crucial detail here is that Apple is relying on Google Cloud and NVDA chips for their advanced AI workloads.
Which is a huge pivot.
Think about that for a second. Apple, the company famous for its walled garden, right? The company that spent billions developing its own custom M-series computer chips, specifically so they wouldn't have to rely on anyone else.
Right, the whole point was vertical integration.
Exactly. And now they're outsourcing their heavy AI lifting to their biggest rivals.
To understand why that is such a massive concession, we have to look at the architecture of artificial intelligence.
Okay, break that down for us.
So Apple's internal silicon, their M-series chips, they are incredible at what we call edge computing.
Meaning running things on your actual device.
Exactly. They are highly efficient at running tasks locally on your laptop or your phone. But generative AI is a completely different beast.
Fundamentally different.
Yeah. Training massive language models doesn't happen on a laptop. It requires tens of thousands of highly specialized graphics processing units, GPUs, working in tandem inside massive, energy-hungry server farms.
And Apple just doesn't have those farms.
No, they don't. And right now, NVIDIA has a near-total monopoly on that specific type of data center architecture. Apple simply does not have the internal infrastructure to process that sheer volume of data.
So I look at it like a newly discovered massive deep-sea oil field. Apple is a dominant oil company, sure, but they just realized they only own onshore drilling equipment.
That's a great analogy.
And NVIDIA owns all the deep-sea rigs, and Google owns the underwater pipelines. If Apple wants the oil, the generative AI, they have absolutely no choice but to rent their rivals' equipment at whatever price they demand.
That is the exact dynamic playing out. Apple's reveal essentially validated that owning the foundational hardware is the only true prize right now.
They practically guaranteed cash flow for Google and NVIDIA.
They really did.
Which brings us to the collateral damage of this arms race. Let's look at Oracle. According to the briefing, Oracle reported better than expected earnings and revenue for its fiscal fourth quarter.
Right, a solid earnings beat.
And usually an earnings beat means the stock goes up. But the stock was brutally punished by the market today. It dropped like a stone.
Yeah, the market did not like their forward guidance.
Because alongside that earnings beat, Oracle announced plans to raise an additional $20 billion. dollars.
And in the macroeconomic environment we just outlined, with the 3-year high CPI and expensive debt, asking for $20 billion is a terrifying prospect for investors.
Because if you are raising that kind of money right now, you really only have two options, right?
Yeah.
And both are painful.
Very painful.
You are either borrowing it, which means taking on debt at those punishing interest rates, which severely cuts into your future profits just to service the interest,
Yeah.
or you are issuing new stock.
Which dilutes the value of the shares that current investors already own.
Exactly. Either way, the shareholder pays the price today. But my question to you is Oracle's panic a direct result of what Apple just proved?
It is entirely connected.
Really?
Yes, Oracle operates massive cloud databases. They saw Apple concede to NVIDIA and Google, and Oracle realized that if they don't buy the absolute best, most expensive NVIDIA chips right now, their entire cloud infrastructure becomes obsolete.
Wow.
They are forced into this $20 billion capital raise just to buy the deep-sea drilling rigs, as you put it.
Just stay in the game.
Right. The market punished Oracle because investors realized the cost of just staying competitive in the AI era is becoming astronomically, perhaps prohibitively expensive.
So building the digital future is suddenly breaking the bank. But if you think that requires a lot of capital, wait until we look at the companies trying to build new physical infrastructure.
Oh yeah, the scale here is wild.
Because the scale of capital allocation in today's briefing is truly historic. Let's start on the ground with Amazon.
Amazon is an incredible case study in weaponizing efficiency.
The briefing notes that Amazon is heavily expanding its trucking logistics. Now, this isn't just Amazon delivering your crime packages anymore.
No, they're moving way beyond that.
Right. They are aggressively moving into the broader commercial freight market. And this news sparked a massive sell-off in traditional freight stocks today.
You have to look at the mechanics of why legacy freight companies are absolutely terrified of this.
Why are they panicking?
Well, for the last 20 years, Amazon has been building this massive closed-loop logistics network. But the biggest inefficiency in trucking generally is what the industry calls the empty backhaul.
The empty backhaul. Okay, explain that.
So you pay a driver to haul a trailer full of goods from Chicago to St. Louis.
Okay.
But if that trailer is empty on the drive back to Chicago, you are burning fuel and paying wages for zero revenue on the return trip.
Ah, you are just eating the friction of that high CPI we talked about.
Right. You're losing money on the way back. But Amazon effectively realized they have thousands of trucks driving back empty after dropping off their own internal packages.
Oh, I see where this is going.
By opening up their logistics network to outside companies, they can fill those empty return trips with other companies' freight.
And because the truck was already making the return trip anyway?
Amazon's marginal cost for hauling that extra freight is practically zero.
Wow. So they can instantly undercut the prices of legacy freight companies who actually rely on those routes for their core margins.
Exactly. Amazon is taking the friction of the physical world and turning it into a pricing weapon against their competitors.
It is brilliant, but it is brutal for the rest of the industry.
It is. But as aggressive as that is, the true definition of weaponizing capital today comes from the aerospace sector.
Yes. Let's talk about the literal moonshot in this briefing.
The SpaceX numbers.
It's insane. SpaceX is set to launch the largest initial public offering, the largest IPO in human history. The numbers in this briefing require a double take. They are targeting a $1.77 trillion valuation.
Trillion. With a T.
Trillion. And they're seeking a $75 billion capital raise.
Just to put that $75 billion raise into context for a second, that single capital injection is larger than the entire gross domestic product of dozens of sovereign nations.
It's unbelievable.
It is a staggering absorption of market liquidity.
But I have to push back hard on this. I am looking at the risk profile in this briefing. SpaceX is projected to trade at 94 times sales.
Multiple is very high.
Very high. For you listening, that means for every single dollar of revenue SpaceX actually brings in the door, investors are willing to pay $94 just to own a piece of it.
Which is a huge premium.
And on top of that, they posted a massive $4.94 billion net loss in 2025, nearly a $5 billion loss in a single year.
Right, they're burning cash.
We just established how expensive money is, how inflation is at a 3-year high, and how the market punished Oracle just for wanting to borrow money. How do you justify a 94x multiple while bleeding $5 billion? I mean, are investors completely detaching from reality here?
It looks completely irrational on paper, I agree. But it perfectly highlights the deep polarization in how the market values the future right now.
Polarized how?
Well, trading at 94 times sales while losing billions violates every traditional rule of value investing. But investors in this specific IPO are not buying current cash flow. They're buying a monopoly.
A monopoly on low Earth orbit.
Precisely. The market is fracturing into two distinct camps right now. Camp A demands immediate cash flow and safety. They're terrified of the inflation and the geopolitical risks we discussed earlier.
They want safe, reliable returns today.
Right. But Camp B operates on a completely different time frame. They believe that the companies building the foundational infrastructure of the next century, whether that is artificial intelligence compute or a global satellite internet network like Starlink, they believe these companies will become completely untetherable monopolies.
So the normal financial math just goes out the window.
For Camp B, yes. They're willing to throw unprecedented amounts of money at SpaceX, ignoring the near-term financial bleeding, because they believe the winner-takes-all payoff at the end will justify the exorbitant cost.
Even with high interest rates.
Exactly.
Mm.
It is an incredibly high uncertainty IPO, but the fear of missing out on owning the railroad of space is overpowering the fear of high interest rates.
It is the ultimate manifestation of our leaky roof versus the lavish future vacation scenario.
That's exactly what it is.
Camp A is paying a premium to fix the roof right now, and Camp B is taking out a third mortgage to fund a one-way trip to Mars.
Yeah, that sums it up perfectly.
Which actually brings us perfectly to the actual scoreboard for the day, because when we look at how the market shook out, there is a very clear dividing line between these two camps.
The scoreboard always strips away the narratives and reveals the true sentiment.
So let's look at the movement. Today's most active stocks were SpaceX, Apple, and Google, the titans battling over infrastructure. The top losers were Oracle, Tesla, and Amazon, specifically Amazon's core retail dragging down the stock despite their freight push.
Which shows the physical economy dragging them down.
Exactly. But the top gainers, NVDA, Microsoft, and Starbucks.
Starbucks.
The briefing specifically noted Starbucks as a, quote, bright spot in Wednesday's bleak market, unquote, rising steadily despite the broader indices dropping. And I just have to point out the deep irony here for you.
It's pretty funny.
On a day dominated by trillion-dollar space monopolies, artificial intelligence supercomputers, three-year high inflation, Middle East conflicts, and flesh-eating screwworms,
Yeah.
people just really needed their coffee.
Yeah.
Starbucks acting as the resilient safe haven is such a relatable reality check.
It really is human nature quantified in a stock chart.
Totally.
But if we look at the underlying mechanics, there is a unified thesis separating the winners from the losers today.
What's the pattern?
The winners, NVIDIA, Microsoft, and Starbucks, they all provide something unavoidable. They are either supplying the fundamental mandatory infrastructure for the next technological leap, or they're providing simple, predictable, daily consumer comfort.
Cash flow today.
Exactly. People are not going to stop buying their daily coffee, even if inflation is high. It is a sticky consumer habit.
Right.
And tech companies are not going to stop buying NVIDIA chips, because if they do, they lose the AI race entirely. Both of those scenarios provide highly predictable revenue.
And the losers?
The losers, Oracle, Tesla, and those legacy freight companies, they are caught in the transition.
The messy middle.
Yes. They are the ones asking the market for patience and massive amounts of expensive capital to adapt their business models. And when money is expensive, patience vanishes.
Oh, that makes sense.
The market is effectively saying, we will fund the foundational infrastructure of the future, and we will buy our daily comforts today. But if you are caught in the messy middle, asking for billions to figure it out, we are going to punish your stock.
It's the deep sea drilling rigs or the caffeine and absolutely nothing in between.
That's the market today.
Well, that brings us to the end of our journey through today's briefing. We started in the physical reality of the Strait of Hormuz, navigating compounding inflation and cascading agricultural threats.
The leaking roof.
We watched Apple concede the AI infrastructure race to its rivals, while Oracle got punished for trying to buy its way in. And we looked at the stratospheric, debt-heavy valuations of SpaceX as it tries to fund a multi-planetary monopoly.
And it is all anchored by the relentless friction of capital in the June 10th, 2026 market.
Exactly. And the big takeaway for you listening to this is that whether you're analyzing the impact of a screwworm on grocery prices or the viability of a $75 billion space IPO, understanding this market means understanding that fundamental tug of war.
The intense friction of the present day versus the incredibly expensive promises of the future.
Right. The market is demanding you look at the mechanics of how these companies operate, not just the narratives they sell.
Look at the math.
And as we wrap up, I want to leave you with one final provocative thought to chew on. We saw today that the most valuable tech company in the world, Apple, has to rely on its rivals' hardware to power its AI future.
Yep.
And we saw that the biggest IPO in history, SpaceX, is losing nearly $5 billion a year while trading at 94 times its sales.
Which is unprecedented.
So, what happens to these tech giants and these massive debt fueled valuations if inflation stays at this 3-year high and raising capital simply stops being an option? What happens when the leaky roof finally forces everyone to cancel that futuristic vacation?
That is the trillion-dollar question.
Think about that next time you order your highly resilient, inflation-proof cup of coffee. Thank you so much for joining us for this deep dive. We always love unpacking these chaotic days with you. Take care, and we'll catch you on the next one.